Welcome to Chapter 15 of Essentials of Healthcare Finance, Product Costing. Practically every healthcare provider expresses a strong and urgent interest in developing better cost accounting systems. The basis for this interest is easy to understand and relates to the nature of payment systems for healthcare providers. Before 1983, hospitals and many other healthcare providers were paid on the basis of actual cost. Hospitals, for example, were paid on a cost basis by Medicare, many Blue Cross plans, and most Medicaid programs as well. In this type of payment environment, costing was important, but allocation of costs to heavily cost-reimbursed areas was emphasized rather than accurate costing. Reimbursement maximization, not accurate costing, was the primary objective. And with the advent of prospective payment systems in the early 1980s and the growing importance of managed care in the late 1980s, hospitals and other healthcare providers became concerned with the actual cost of service delivery. Providers wanted to know what the actual costs of producing a medical or surgical procedure were so they could compare these costs with the revenue received and make more intelligent decisions about products and product lines. So this chapter provides the reader with an understanding of the product or service costing in the healthcare setting. It's imperative that today's healthcare manager understand the costs of providing services. Because they are assuming more risk, providers must be able to measure their costs accurately. In a healthcare setting, the primary object to be costed is a patient encounter of some type, either inpatient diagnosis-related group, DRG, an outpatient visit, or some other specific treatment category. Cost information has value in management decision-making, which is often segregated into planning, budgeting, and control decisions. The needs for information may vary depending upon the type of decision that is being made. The development of cost information will depend to some extent upon existing financial reporting systems. Our learning objectives are to describe the existing needs for cost information in healthcare firms, describe how cost information relates to the three key activities of management, planning, budgeting, and control, and to describe the three main phases of the costing process, explain the two systems necessary to accurately cost healthcare encounters of care, and finally describe the concept of relative value units. The three questions for healthcare cost accounting are: what are we trying to cost? For what time period is the cost information of value? And how do our needs for cost information relate to existing cost systems? Healthcare firms produce a large number of products, and many of these products are bundled into an encounter of care. An encounter of care includes all products and services during a specific treatment or episode of care. An example of an encounter for an inpatient would be MS-DRGs, example an MS-DRG 193, which is simple pneumonia and pleurisy with MCC. Or for outpatient APCs, example 0143, which is a lower GI procedure. Time periods will either be historical or future. Historical costing is by itself of little value, but future costs are the most relevant. Interestingly, they do rely on historical cost data. Present financial accounting systems will continue to exist because they fulfill the reporting needs. The basics of most financial accounting systems provide a measure of facility cost, an allocation of facility cost to responsibility centers or departments. The dilemma of costing is how to take departmental cost measures and assign those values to encounters of care. Budgeting translates product decisions into resource expectations. There are two major objectives: assure financial viability of a plan and establish a basis for management control. Primary output of a budget is a set of departmental budgets outlining expected costs. For control and corrective action, deviations or variances from the budget are identified. Corrective action may be taken to correct the variance in future time periods if unfavorable. Sometimes variances may reflect changes in budget assumptions. In what basis should valuation areas be used? In most cases, it's historical cost. Assigning cost to a time period can be an issue in two types of cases: long-lived assets such as buildings and equipment, and normal accruals where costs are recognized prior to expenditures, for example, payroll. The primary task is assignment of costs charged to indirect departments to direct departments. The allocation of indirect costs requires two decisions: the allocation basis, for example, hours worked or square footage, or apportionment method, which is step-down, double distribution, and simultaneous equations. Production phases are the actual process of creating products and services in a healthcare setting and is split into two stages. Stage 1, departments or activity centers acquire resources and produce product service units. Some service units are traceable to the patient, others are not. Stage 2, consumption of service units in a treatment process, example, surgeries or lab tests, etc. Physicians often direct this stage of production. The two required systems for costing encounters of care are standard cost profiles and standard treatment protocols. Standard cost profiles tell how much it did or will cost to produce specific SUs, such as lab tests or surgical procedures. Standard treatment protocols tell us how many units of a SU either were required or will be required to produce a specific encounter of care. Some departments, such as the lab, have many products or SUs. Relative values are often used to collapse many units to just one. In relative value unit RVU costing, some relative weights are assigned for each of the commonly produced outputs. For medical groups, the most commonly accepted classification of outputs is current procedural terminology, or CPT codes.